As the end of the financial year approaches, now's a valuable window to top up your super and take advantage of tax-effective strategies. By optimising your contributions today, you can significantly shape the lifestyle and flexibility that you'll enjoy in retirement. But timing is critical, because super funds generally stop accepting contributions weeks before the 30th of June. In this video, we break down the main types of super contributions and the relevant cap limits. We also share some practical tips to help you make the most of this end of financial year opportunity. I'm Chris Trano, Managing Partner at Toro Wealth and founder of SuperGuy.com.au. We've helped thousands of Australians aged 50 to 70 plan for retirement. If you're new here, hit the subscribe button so you get all of my retirement planning tips. As always, this video is general information, not personal advice. See the full disclaimer below. So why make super contributions before the end of the financial year? Well, contributing to your super before June 30 is a smart way to boost your retirement savings and save on tax. By making extra contributions now, you can strengthen your financial position for retirement and stop unused benefits from going to waste. There are three key benefits of contributing before 30 June. Reduce your taxable income. Some super contributions like personal concessional contributions can lower the amount of tax you have to pay this financial year. Grow your super faster. Super investments are generally taxed at a lower rate than investments owned in your personal name, which can help your retirement savings grow more efficiently. Take advantage of unused contribution caps before they expire. If eligible, you can catch up on unused concessional contribution caps from previous years, but amounts from 2019-2020 financial year will expire on the 30th of June. This is a big deal, especially if you're in your 50s or early 60s. Your final working years are a powerful time to build your super, and the lead up to the end of financial year gives you the perfect window to take advantage of it. You're likely earning and saving more than ever, so it's a great time to make larger contributions and get more into the tax-effective superannuation environment while you still can. Plus, you're contributing to super with confidence that access is just a few years away. So let's take a look at how much you can actually contribute to super. There are a few contribution types and each has its own rules and tax perks. Here's what you need to know before 30th of June. Firstly, concessional contributions. Concessional contributions refer to pre-tax contributions made into your super. They're taxed at 15% upon entry and capped at $30,000 in the 2024-25 financial year. The main types of concessional contributions are the superannuation guarantee contributions paid by your employer, salary sacrifice contributions, and personal contributions that you claim as a personal tax deduction. If eligible, you can increase your contributions cap for the financial year using the carry forward rule. The two key types of concessional contributions you can control are salary sacrifice and personal deductible contributions. A salary sacrifice arrangement involves asking your employer to redirect some of your before tax salary into your super. This is an extra contribution separate to the superannuation guarantee that your employer must pay. To be eligible, the salary sacrifice arrangement must be set up with your employer before the income is earned, and your total concessional contributions, including employer SG contributions, must not exceed $30,000. If salary sacrificing isn't set up yet, it may be too late to start this financial year, so consider making personal deductible contributions instead. Personal deductible contributions are personal contributions which are then claimed as a tax deduction. By doing so, you effectively convert non-concessional contributions to concessional contributions, which are subject to 15% tax. To be eligible, you must be under age 75 and satisfy the work test if 67 or over, and give a valid notice in the approved form to your fund, and receive written acknowledgement from your fund before lodging your tax return, making any withdrawals, commencing an income stream, and prior to the end of the following financial year. Check your total concessional contributions, including SG contributions, are under the $30,000 cap. If eligible, consider using carry forward contributions to increase your cap. Carry forward contributions allow you to carry forward any unused concessional contribution amounts from previous years. In other words, you're able to catch up on your concessional contributions. This is a smart way to boost your super and save on tax. To be eligible, you must have a total super balance of less than $500,000 on the most recent 30 June and unused concessional contribution cap amounts from one or more of the past 5 years. Consider making extra concessional contributions to super, if eligible, before 30 June to use up the available carry forward amounts. Unused cap amounts expire after 5 years. This means that any unused concessional contribution space from 2019-20 will disappear if you don't use them by 30 June 2025. To claim a tax deduction, make your contribution before 30 June. Next, submit a notice of intent to claim to your fund and receive acknowledgement before lodging your tax return. I've done a full video on unused concessional contributions. The link is in the description. That's concessional contributions covered. Now let's look at how you can boost your super with non-concessional contributions. Non-concessional contributions are made from after-tax income for which you don't claim a tax deduction. These contributions aren't taxed when they enter your super fund. While they don't reduce your taxable income, non-concessional contributions can significantly grow your super, especially if you've maximised your concessional contribution cap. The total cap for non-concessional contributions is $120,000 in the 2024-25 financial year. The main types of non-concessional contributions are personal after-tax contributions, spouse contributions, and co-contributions. If eligible, you can increase your contributions cap using the bring forward rule. Firstly, let's look at personal after-tax contributions. Personal after-tax contributions are those made from after-tax income for which you don't claim a tax deduction. These contributions don't reduce your taxable income, but they help grow your super in a low tax environment. Earnings on non-concessional contributions are taxed at a maximum of 15% whilst in accumulation phase. Once you retire, those earnings then become tax-free up to the cap limits. To be eligible, you must be under age 75 and have a super balance less than 1.9 million or 2 million for the 2025-26 financial year. Personal after-tax contributions are useful for boosting super, especially if you've used up your concessional contributions cap. Make contributions before 30 June if you want them to count this financial year. Use savings or extra income like bonuses. If eligible, you could contribute up to $360,000 using the bring forward rule. More on this rule later in the video. The next type of non-concessional contributions you can make is a spouse contribution. These contributions are made to your spouse's super account and can earn you a tax offset of up to $540. To be eligible, your spouse must earn under $40,000, be under age 75, and your contribution must be from after-tax income. Make a spouse contribution before 30 June to claim a tax offset this year. Next, we have a co-contribution. If you're a low or middle income earner and make personal after-tax contributions, the government may make a matching contribution. This is known as a co-contribution. The co-contribution you receive depends on your income and how much you contribute to super. Make a personal after-tax contribution before 30 June and lodge your tax return. If eligible, the ATO will pay a co-contribution automatically. As we mentioned, the total cap for non-concessional contributions is $120,000 in the 2024-25 financial year. However, if eligible, you can increase your contributions cap by using the bring forward rule. The bring forward rule lets you make up 3 years worth of non-concessional contributions in one financial year without paying extra tax. It works by giving you early access to future non-concessional contribution caps up to $360,000 at once. To be eligible, you must be under age 75 and have a total super balance of less than $1.9 million or $2 million for the 2025-26 financial year. The non-concessional contributions cap is $120,000. If you go over this and meet the eligibility conditions, the bring forward rule is automatically triggered. The bring forward rule can be a powerful end of financial year strategy, especially before retirement. It allows you to contribute up to $360,000 in 1 year, helping you fast track your super if you have surplus funds. Check your eligibility and super balance before contributing. If you're close to the $120,000 cap, consider splitting contributions across June and July. This can delay when the bring forward rule starts, giving you more flexibility for tax and planning purposes. For example, if you have even more to contribute, you might consider contributing $120,000 prior to 30 June and $360,000 in July, because the bring forward rule is only triggered in the year that you exceed the general $120,000 cap, thereby getting a total of $480,000 into super within the space of a month. There's one more way to give your super a boost, and the best part, it doesn't count towards your non-concessional contribution caps. It's called a Downsizer Contribution. Downsizer contributions allow eligible homeowners to transfer up to $300,000 per person from the sale of their home into super. To be eligible, you must be 55 or older and sell a home owned for at least 10 years. Make your Downsizer contribution within 90 days of receiving the proceeds of the sale. If your 90-day deadline falls before 30 June, contribute now so it counts this financial year. Lodge the Downsizer form within your fund either before or at the time of your contribution. Making Downsizer contributions strategically can support age pension planning. For example, super held by a partner under age pension age, which is age 67, isn't counted in the assets test. As Downsizer contributions don't affect your contributions caps, They can also be combined with strategies like the bring forward rule. Let's look at how different contribution strategies can work together in practice. This next example is based on a client we helped recently. We've changed her name to Sarah to respect her privacy. Sarah is 60, earns $85,000 a year, and plans to retire in June 2026. Currently, Sarah has $50,000 in her bank account, has $400,000 saved in super, and is salary sacrificing $160 per fortnight into super. Her goal is to grow her super, cut her tax bill, and still have cash for day-to-day living. Here's the strategy. Step 1. Catch up on unused concessional contributions. Sarah had $50,000 in unused concessional contribution caps. We recommended a $40,000 personal concessional contribution using her bank savings. This strategy made use of her unused cap and resulted in a $6,750 net tax saving even after contributions tax. She now has more in super and a smaller tax bill. Step 2, maximize salary sacrifice in the final working year. From 1 July, Sarah ramped up her salary sacrifice to $1,700 per fortnight. This boosted her super and delivered another $6,754 in tax savings. That's $13,505 in tax saved over 2 years. Step 3, use a TTR pension to replace the income. To meet the cash flow shortfall from salary sacrificing, Sarah started a transition to retirement pension with $400,000 of her $440,000 balance. She drew $2,300 a month, keeping her income steady while her super kept growing. By smart planning, Sarah boosted her super, reduced her tax, and stayed financially comfortable along the way. So with the end of the financial year approaching, it's the ideal time to review your super strategy. By checking your caps and timing of your contributions, you can meaningfully reduce tax and boost your retirement savings. Make sure your contributions are received and processed by your fund and all the necessary paperwork is submitted well before 30 June. If it all feels a bit too much to juggle, we're here to help. Let Toro Wealth help simplify your contribution strategy and tailor it to your goals. To learn more, head over to torowealth.com.au. If you found this video helpful, give it a like and subscribe for more retirement planning tips. See you on the next one.